You bought the house, the lawn is trimmed, the kitchen looks like a Pinterest board. The neighbors think you made it. On paper, you're winning, but inside, you're eating ramen in a $400,000 house, refreshing your bank app, and having a minor panic attack because the dishwasher just made a weird sound. That is the modern version of success in America. Paper wealthy, reality broke. You've got equity on a spreadsheet, but no cash in real life. You own the asset, but the asset owns your behavior. You can't travel without guilt. You can't breathe when an unexpected bill hits. You can't enjoy the house because every square foot comes with a monthly threat. And this is the part nobody says out loud. A lot of people are not building wealth through homeownership. They are financing an image while living in survival mode. We were programmed to believe that renting is throwing money away. So people rush to buy because they're terrified of being the adult who still rents. But what if buying the wrong house at the wrong price is worse? What if the real money pit isn't rent, it's a mortgage that turns your entire life into a cash flow hostage situation? Because if your house kills your liquidity, traps your career, and keeps you one emergency away from panic, that's not freedom. That's just landlord free, but freedom-less. And the data backs up the feeling. In Harvard's 2025 housing report, 20.3 million homeowners were cost-burdened in 2023, meaning they spent more than 30% of income on housing and utilities. That's 24% of all homeowner households. And the number has risen by 3.6 million since 2019. Source: the death of the 28% rule. There used to be a rule, a boring, responsible, unsexy rule. The 28/36 rule said you shouldn't spend more than 28% of your gross income on housing, and no more than 36% on total debt. It wasn't glamorous, but it existed for a reason: to leave you enough oxygen to actually live. Now look at 2025. That rule is basically dead for millions of buyers. Prices detached from income. People stopped asking, "Is this affordable?" and started asking, "Can I somehow survive this?" A Tom found that in 74.1% of U.S. counties, the major costs of buying a median-priced home consumed more than 28% of typical wages in late 2025. Nationally, those ownership costs, mortgage, taxes, insurance, and mortgage insurance ate up 31.4% of the average wage. And that's before your life happens. And if you want the bigger picture, it gets uglier. Over the past 5 years, a Tom says home prices rose 54%, while wages rose 29%. The National Association of Realtors found that households earning $75,000 a year could afford only 21.2% of listings as of March 2025. In a balanced market, they'd need access to 48.1% of listings. So people aren't crazy for feeling squeezed. The math really is broken. And here's the lie hidden inside the real estate is the best investment slogan. If you stretched so hard to buy the house that you have no emergency fund, no retirement contributions, no index fund investing, and no margin for life, then your house didn't make you an investor. It made you a liquid. A real investment expands your options. A bad purchase shrinks them. The myth of security vs. the landlord narrative. Let's deprogram one of the loudest myths in personal finance. Owning is not automatically better than renting. Yes, renting doesn't build home equity, but if owning leaves you broke every month, you're not exactly building freedom either. You're just slowly paying interest, taxes, insurance, and maintenance, while telling yourself it's wealth because someone on the internet said, "At least it's yours." In this market, mine can become very expensive. Investopedia highlighted in 2025 that renting can preserve liquidity, provide flexibility, and even outperform buying if you invest the difference. In one planner's example, using a $430,000 home, renting came in nearly $400 cheaper per month once insurance, taxes, maintenance, and HOA fees were included. That's not a universal rule, but it destroys the lazy idea that renting is always the dumb option. And let's be honest about the social pressure. For a lot of people, buying a house around 30 to 35 isn't about math. It's about optics. It's the adult achievement badge, the proof that you're stable, successful, respectable. But the truth is brutal. Liquid money in a savings or brokerage account often gives you more actual security than equity trapped inside a house you can't access without refinancing, selling, or uprooting your life. The Consumer Financial Protection Bureau warns that without emergency savings, even a minor financial shock can push people into debt, while Vanguard notes that liquid accounts are valuable precisely because they're accessible when life punches you in the face. So know the goal is not just to become landlord-free. The goal is to become financially secure, and those are not the same thing. The golden handcuffs effect. This is where homeownership stops being a budgeting issue and becomes a life design issue. A heavy mortgage can kill your ability to take career risks. You stop thinking strategically and start thinking defensively. You don't ask, what move grows my income? You ask, what move keeps the lights on? That is the golden handcuffs of homeownership. When your house poor, you can't quit the toxic job. You can't step back to retrain. You can't take the lower paying opportunity that might lead to something bigger later. You can't launch the side business with conviction. Every decision gets filtered through one question. Can I survive missing one paycheck? And economists have actually measured part of this lock-in effect. Research summarized by the National Bureau of Economic Research found that each 1 percentage point gap between a homeowner's old mortgage rate and current market rates is associated with a 7.7% decline in their quarterly probability of moving. Between mid-2022 and late 2023, mortgage rate lock discouraged about 800,000 moves. In other words, housing debt doesn't just hit your wallet, it reduces mobility. Now compare that to a renter with a $30,000 freedom fund. That person can move cities. They can take a certification course. They can survive a layoff without instant panic. They can leave the abusive boss. They can make short-term sacrifices for long-term upside. One person owns a house. The other owns options. And in a fast-changing economy, options are often the more valuable asset. The maintenance monster, here's the part HGTV forgot to mention. A house is not just a payment. It is a machine that breaks. The roof leaks. The HVAC dies in July. The water heater fails on a random Tuesday. The tree roots mess up the plumbing. The insurance deductible shows up exactly when your savings don't. According to Angie, the average roof replacement costs about $9,528. Their HVAC replacement estimate averages about $7,500, with common ranges between $5,000 and $12,500. These are not luxury upgrades. These are pay now or suffer expenses. And then there are the hidden recurring costs. Bankrate's 2025 study estimated the average annual hidden cost of owning a single-family home at $21,400. That included $8,808 for maintenance, $4,316 for property taxes, $4,494 for utilities, $2,267 for homeowners insurance, and $1,515 for internet and cable. So when someone says, my mortgage is only $2,000, what they often mean is, my base obligation is $2,000 before reality arrives. Because a $2,000 mortgage can behave like a $3,000 lifestyle commitment. Once you add taxes, insurance, HOA dues, utilities, and repair. That's before kids, before healthcare, before car trouble, before life. And this is how the debt spiral starts. The CFPB warns that without savings, even a modest financial shock can push people toward credit cards and loans, turning one emergency into longer-term debt. So the house-poor buyer doesn't just pay for repairs. They finance repairs at 20% interest and call it adulthood. Quality of life and relationship strain. This isn't just a math problem. It's a quality of life problem. Financial pressure changes the emotional atmosphere of a home. The house that was supposed to feel like peace starts to feel like a supervisor. Every weird noise becomes a bill. Every invite out becomes, we should probably save. Every dream gets delayed until things settle down. And somehow they never do. The American Psychological Association says worries about money are a significant source of stress and affect housing decisions, healthcare decisions, family planning, and relationship conflict. So when people become house poor, the cost isn't just financial. Life gets smaller. You withdraw from friends. You work hours you hate. You tolerate situations you should leave. You become a servant to the thing that was supposed to serve you. That's the ugliest part of survival mode living. It doesn't always look dramatic from the outside. It just quietly steals your joy. The way out and prevention: if you already own the house and it's crushing you, the first step is brutal honesty. You may need to sell it. You may need to rent out a room. You may need to cut expenses with zero sentimentality. You may need to stop protecting the fantasy and start protecting your life. If a room rental brings in $800 a month, that's not failure. That's oxygen. If selling the house restores your cash flow, mobility, and mental health, that's not losing. That's escaping a bad trade. And if you haven't bought yet, here's the contrarian advice. Buy less house than the bank says you can afford. A lender approves payments. They do not approve peace. Aim more conservatively, roughly 2.5 to 3 times your annual income if you want margin, not maximum strain. Treat 20% down as a stability goal when possible, because it lowers the loan burden and helps you avoid PMI. Bankrate notes that the median down payment in 2025 was 19% overall, but only 10% for first-time buyers. That gap helps explain why many new buyers walk into heavier monthly pressure. And PMI itself can add roughly $115 to $375 per month on a $300,000 mortgage. And don't buy until you have an emergency fund separate from the down payment. The CFPB recommends dedicated emergency savings for unplanned shocks, while Vanguard recommends building toward 3 to 6 months of living expenses for income shocks. If buying the house empties you out completely, you are not ready for the house. You are ready for the risk. Source, because the real goal is not to impress people with granite countertops while your checking account flatlines. The goal is freedom. A house should be the place you live your life, not the reason you don't have one.